Alright, I've been coin. This is Chess and Wine here. I want to do a video recap of my daily charts. You're looking at the S&P 500 right now, a daily chart of that. And you can see these two horizontal pink lines, which I'm highlighting right now, define the upper and lower boundaries of our multi-month trading range that we have essentially been in since May 20th of this year. This big red candle brought us down into this range. And it is my opinion that we've been in a trend-less market with amorphous price action. We've had no real shape to any of these moves here. Sure, you can make the argument for an inverted head and shoulders bottom, but again, presuming you could also make the case for a head and shoulders top dating back to January. So you have competing forces here between ideological bulls and ideological bears. By far, the best strategy has been to be as neutral and unbiased as you can and to simply trade the range. When we get up here above 1100, 1120, 1130, by far, again, the best strategy has been, in the face of pervasive bullish sentiment up here, to lighten up on your longs and in fact go short, or at least hedge yourself. When we get down here to the bottom end of the range, around 1040, once again, by far the best strategy has been to lighten up on your shorts and go long or completely unhedge yourself. So, you know, what's also important to know is that each time we've tried to break out of this multi-month trading range, it has been aggressively faded. You can see here June 21st, tried to break out, 1131, aggressively faded. July 1st, 1010, tried to have a major breakdown, again, aggressively faded to the upside. So what that does is just reinforce the trading range once again. So here we are. Right now, we finished Friday at 1109 in the S&P, and we're at the upper end of the multi-month trading range. We've been essentially drifting higher the past 2 weeks, ever since we rejected 1040 once again. And here's the pressing issue, is would you allocate right here, right now, fresh capital to the long side based on this chart? My answer is no, I would not. My position is neutral. I have a heavy cash position. I am hedged. And I'm simply going to let the institutions do the heavy lifting for me. If indeed we are going to break out of this multi-month trading range, in my opinion, we're going to need to see an uptick in volume. The volume last week was paltry because of the Labor Day holiday, probably, as well as the Jewish holidays. So if we are going to break out of this multi-month trading range and start a fresh new uptrend, then I'm simply going to need to see more evidence of that. We're going to need to see strong institutional buying. I know right here, right now, many ardent bulls are saying the trend is your friend, you know, until it bends in the end, the old Wall Street axiom. I tend to agree with that under normal circumstances. But right here, right now, once again, Mr. Market is not your friend. If you've been a steadfast bull, you know, over the past few months, you've been punished right up here. Each time you've been bullish up here. If you've been a steadfast bear, you've been punished down here. Again, Mr. Market has not been friendly to those who believe we're in a trending market. We're not. And if we are going to transition into one, like I said, let the institutions do the heavy lifting for you. And then, by definition, if it is a sustainable uptrend, like I said, by definition, there will be time to get in if you're watching the market every day like we are. So right here, right now, again, defensive neutral posture. Going into next week. Once again, same thing with the NASDAQ. Similar situation. No need to be a hero whatsoever. Drifting up towards the upper end of the multi-month trading range. You know, why be a hero right here, right now? Each time it's happened over the past 3 or 4 months, you've been aggressively punished for being a hero. Dow Jones Transportation Index. You can see the wicks on the top of these candles over the past few days. That's a classic sign of supply overwhelming demand. You really want to watch out here. It's tough resistance, overhead supply, the concept of prior bulls who've been trapped. They want to just get out and cut their losses or get even while they can once they are made whole again. Russell 2000 small caps, good job of consolidating above the 50-day moving average. But again, why be a hero right here, right now, towards the upper end of the range? Emerging markets, pretty good, but again, no conviction either way. We're doging out just above that multi-month symmetrical triangle.